Tariffs are essentially taxes imposed on imported goods. Governments use them for various reasons, often to protect domestic industries from foreign competition. By making imported goods more expensive, tariffs aim to make domestically produced goods more appealing to consumers. This can help shield local businesses and jobs from being outsourced. However, tariffs are a double-edged sword. While they can offer short-term protection, they often lead to higher prices for consumers. This can have a cascading effect, potentially slowing down economic growth and impacting overall market sentiment. The imposition of tariffs is a delicate balancing act. Governments must weigh the potential benefits of protecting domestic industries against the risks of triggering trade wars, harming consumers, and disrupting global economic stability. The stock market, a barometer of investor confidence, often reacts swiftly and dramatically to news that could impact economic growth. Tariff announcements, particularly those perceived as disruptive or likely to escalate trade tensions, can send shockwaves through global markets. Investors tend to react negatively to uncertainty. Tariffs introduce an element of unpredictability into the global trade landscape. They can disrupt supply chains, increase costs for businesses, and ultimately impact corporate profits. This uncertainty can lead to a sell-off in the stock market, as investors attempt to reduce their exposure to potential risks. Major stock market indices, such as the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite, can experience significant declines in response to tariff announcements. In 2018, the Trump administration announced tariffs on billions of dollars worth of goods imported from China. This ignited a trade war between the world's two largest economies, sending shockwaves through global markets and raising concerns about a potential slowdown in global economic growth. The initial announcement of tariffs on Chinese goods was met with a swift and negative response from the stock market. The Dow Jones Industrial Average, a closely watched indicator of the health of the U.S. stock market, tumbled by over 600 points on the day following the announcement. Other major indices, such as the S&P 500 and the Nasdaq Composite, also experienced significant declines. The market reaction was driven by a number of factors, including concerns about the impact of the tariffs on corporate profits, the potential for retaliatory tariffs from China, and the overall uncertainty that the trade war injected into the global economic outlook. The Dow Jones Industrial Average, a bellwether for the U.S. stock market, plummeted by over 2% in the immediate aftermath of the Trump administration's tariff announcement. This translated to a loss of over 600 points, wiping out billions of dollars in market value in a single trading session. The S&P 500, a broader index that tracks 500 large-cap U.S. companies, also experienced a sharp decline, shedding over 2% of its value. The tech-heavy Nasdaq Composite, heavily weighted towards companies with global supply chains, suffered a similar fate, dropping by over 2%. These numbers illustrate the immediate and significant negative impact that the tariff announcement had on investor confidence and the broader market sentiment. Section 5, Investor Psychology, Decoding the Fear Factor. The stock market is not merely driven by rational calculations of economic indicators, it's also heavily influenced by human emotions, particularly fear and greed. Tariff announcements, especially in the context of a burgeoning trade war, tap into these primal emotions, often leading to irrational market behavior. The uncertainty surrounding the potential impact of tariffs, the possibility of retaliatory measures, and the specter of a global economic slowdown all contribute to a climate of fear among investors. This fear can trigger a herd mentality, where investors, fearing further losses, sell their holdings, exacerbating the downward pressure on stock prices. This can create a self-fulfilling prophecy, where the fear of a market downturn becomes the very catalyst for a more pronounced decline. Section 6, History Repeats, Echoes of Past Tariff Battles. History is replete with examples of tariffs sparking trade wars and causing significant economic disruptions. The Smoot-Hawley Tariff Act of 1930, often cited as a cautionary tale, exacerbated the Great Depression by triggering a wave of protectionist policies globally. The Smoot-Hawley Tariff Act, intended to protect American farmers and businesses from foreign competition, had the unintended consequence of sparking retaliatory tariffs from other countries. This resulted in a sharp decline in global trade, exacerbating the already dire economic conditions of the Great Depression. While the global economic landscape is vastly different today, the lessons from the Smoot-Hawley era serve as a stark reminder of the potential dangers of protectionist trade policies and the interconnectedness of the global economy. Section 7. Beyond the immediate long-term implications of trade wars. The immediate market reaction to tariff announcements is often characterized by volatility and uncertainty. However, the long-term implications of trade wars can be far more profound and damaging to global economic growth and stability. Trade wars, by their very nature, disrupt global supply chains, increase costs for businesses, and ultimately lead to higher prices for consumers. This can stifle economic growth, reduce consumer spending, and lead to a decline in corporate profits. Moreover, trade wars can foster an environment of uncertainty and distrust, making businesses hesitant to invest and consumers wary of spending. This can create a vicious cycle, further dampening economic activity and prolonging the negative effects of protectionist trade policies. Section 8. The ripple effect, tariffs and the global economy. In today's interconnected world, economies are inextricably linked through complex webs of trade relationships. Tariffs, particularly those levied by major economies, can create ripple effects that reverberate throughout the global economic system. When a large economy like the United States imposes tariffs, it can have a domino effect, prompting other countries to retaliate with their own protectionist measures. This can escalate into a tit-for-tat trade war, disrupting global trade flows and creating an environment of uncertainty and instability. Emerging markets and developing countries, often heavily reliant on trade, are particularly vulnerable to the negative consequences of trade wars. Disruptions in global trade can stifle their economic growth, limit access to essential goods and services, and exacerbate existing social and economic inequalities. Section 9. Conclusion. Navigating the uncertain waters of trade policy. Tariffs, while often touted as tools to protect domestic industries and jobs, are blunt instruments that can inflict significant collateral damage on the global economy. Their use often triggers market volatility, erodes investor confidence, and risks igniting retaliatory measures that escalate into full-blown trade wars. Navigating the complexities of international trade requires a delicate balance between protecting national interests and fostering a spirit of cooperation and open markets. While there may be times when tariffs are deemed necessary, their use should be judicious, strategic, and always mindful of the potential for unintended consequences. The interconnectedness of the global economy dictates that cooperation, rather than confrontation, is the most effective path to sustainable economic growth and shared prosperity. History has shown time and again that trade wars benefit no one, leaving a trail of economic devastation and fractured international relations in their wake.